What's new? Hi, my name is David So. I'm with the Mortgage Center. And today we're going to talk about this new guideline or the implementation of the guideline that was announced by the Department of Finance earlier this year. And this will become effective as of April 19, 2010. There are basically four main changes to these guidelines. Changes to the qualifying interest rate, changes to the loan-to-value, changes related to rental properties, and changes to the insured second home criteria. There's a term we need to introduce right now. The term is MQR. It stands for Mortgage Qualifying Rate. It simply means this. It's a rate that's defined by the charter bank using the conventional 5-year posted rate. Now this rate, since all the banks have slightly different rate, this rate will be published by the Bank of Canada every Wednesday on the website. Simply go to bankofcanada.ca and go down to the interest rate section and you'll find this rate. As to the qualifying interest rate that we mentioned, this is one of the four things that were changed. The qualifying rates now are as follows. If you were to take a fixed mortgage rate of less than 5 years, then you must use the MQR or the contract rate, whichever is higher. If it is a variable rate, then again it's the greater of MQR or the contract rate. If it's a 5-year fix or a longer term, then you can use the lower rate, which is the contract rate. The loan-to-value also changed. If you were to take extra money out from your house, as in the industry term it, equity take out, now you can only take out up to 90% of the value of your home compared to the 95% previously. Now, as in the case of a rental property or investment property that you're not living in, whether it's a purchase or a refinance, the maximum is 80% that you're allowed to take out. Now, the other thing they also changed is the total debt servicing ratio. It is now limited to 42%. The 44% in the old days is gone. Not only that, this is a tier system and it's based on the credit score. So what they're saying is the maximum they will allow is 42%. And if your credit score is not as high as they like to see it, then the debt ratio could be lower accordingly. As to insured non-owner occupied properties, meaning rental or investment, now the new rule is simply only 50% of the gross rental income is allowed to be added to your gross income. It used to be 80%. So the way to calculate that is simply take your PIT and heat on the subject property plus all your debts plus the PIT on your rental, and then you divide that by your gross income plus only 50% of the rental income from the subject properties. And if you own more than one properties, then the other rental income, but then of course all the other rentals income expenses also applied. As to conventional, we have to be careful when we say that now, because today many mortgages are securitized in order to keep the interest rate low. That means the mortgage must be insured before they can sell that as part of the MBS product on the stock market. So CMHC rules still applies if the lender decide to securitize that particular product. Now, of course, we can say no CMHC, forget about CMHC. There are lenders out there still available like we have had all these years, but then the approval and the pricing will be at the lender's discretion. This is just like the good old days, and I can still remember 20 years ago, these were the things that what people come to mortgage brokers for. So now we're just back to the good old days, but the key is to make sure you find a mortgage broker that understands how to work it. As to second home, the second home rule changed a little bit. Prior to this, you were allowed to have up to 4 units in a property. Now, you can have only 1 unit, and it must be owner-occupied by either the borrower or a relative to the borrower, and it must be rent-free. Just to add a little tidbits to this as well, as as to the credit score, as many of you know that insurance companies now are using credit score to determine the pricing. Home insurance, car insurance, they will run a credit on you, and if your credit will determine how much they're going to charge, because their theory is that people with poor credit, the home has a tendency to catch on fire, and there are more claims and repair, and so are the cars. Now, as to the credit score usage in financing, that's been going on for years now. Basically, it's in twofold. You'll find a credit score has been used traditionally to price your product, meaning if you have great credit, then you have a very good rate. You got slightly blemished credit, you may have to pay a premium, and if you have a terrible credit, well, you may not even get an approval at all. Now, the credit score also price the loan to value. So if you want 5% down payment, well, you must have 680 credit score or higher. Otherwise, you may have to come up with 10% or even 15%. So, anything bad about this new guideline? Well, we know what the government is trying to do. They're trying to slow down the housing market. So with this guideline, basically is you're going to find that you're going to need more money for down payment, and you can qualify for less, which means you need more money to buy less. And I believe it translates to fewer purchasers for both home buyers and investors alike. But what are the good things about this? Well, I believe that there will be fewer buyers, translate to more renters. And if there are more renters, that means renters will help landlords to profit more. So I believe the conclusion to this could be simply this: be a landlord, or at the very least, help someone to be a landlord.